First monetary policy of the new governor, a lot of first for the year, first from the new governor, and the first one after the budget. Everything has moved as per the script, which is identifying that the economy, identifying and admitting that the economy is slowed down, acknowledging that inflation is coming under control, and also stating the obvious, which is that Reserve Bank of India's main job is not to intervene in the market but ensure the volatility in the forex market is over. MPC unanimously voted that the rate cut is required, but for me the specific mentions on liquidity directly, indirectly, not for overnight operations, but for ensuring that the liquidity in the system does not get squeezed out. Very small announcements in terms of a literacy mission for the government, a specific mention in terms of increasing the bond portal platform, but the fact that there's a reassuring point which is coming on the liquidity front is far more satisfactory, far more exciting than what the general view on the street was. The GDP estimates, now I'm surprised why markets are saying that, okay, this is not good, because everyone knows that the economy has slowed down. The ECO survey or the economic survey tabled a day before the parliament has already given out estimates for FY26. So it's not vastly different than what everybody thought. The nominal GDP, if I add the GDP and if I add the current inflation forecast, it is not strikingly different. Yes, optically the 7 number has gone and it has come to 6. 6.7 in FY25, 7 in FY26, which means that the governor and the RBI feels that there could be a mild recovery. Could that mild recovery coming back to 7 take it higher in Q3, Q4? That is the difficult part to understand and ascertain right now. Vinod Kumar, Managing Director and CEO of Indian Bank, joins us now. Tanvi Gupta is also ready. She represents UPS. So Tanvi, everything is on expected lines. The surprise is that there is no surprise.
I completely agree. I think the market was expecting a rate cut. He delivered. There was some chatter on Ciara, which was not our base case. So thankfully, he clearly highlighted that RBI is very well prepared to help with both transitory and durable liquidity. The only surprise which I have is a very optimistic GDP growth projection for next year. RBI has announced a 6.7% GDP growth for FY26, especially at a time when the global uncertainty is on the rise. I mean, we have already seen under Trump administration higher trade tariff on China. I mean, he did also announce for other selected countries which are on hold. So I think that is the biggest risk in terms of global uncertainties on the rise. And we need to see how much India directly and indirectly gets impacted because of that. So if I compare with my UBS estimate for FY26, we are at 6.3% forecast, and this is assuming trade tariff on China. I mean, our forecasts are a bit aggressive, I would say. Our forecasts are assuming that the global economy is going to slow down from 3.2% in 2024 to 3 and 2.7% in 2025-26. A 60% US tariff on imports from China from September 25 was a base case. So I do understand India is a lesser impacted country relative to more Asian open economies, but it is not immune. So I think the 6.7% forecast that RBI announced, I think is likely on the optimistic side, looking at the global uncertainty. The inflation forecast, what they are projecting at 4.2%, is exactly in line with what we have been estimating. So I would say net, we still think that there is a shallow monetary easing is definitely has started today, and we are expecting further 50 basis point of rate cut in this cycle.
Mr. Kumar, how is this credit policy different from the previous governor? You can speak your heart out.
Yeah, so this is welcome move by the new governor. And market was expecting 25 basis point rate cut, and he has delivered. So it is welcome move. One or two things, stance has been maintained at neutral, which is also in expected line. As you also touched on liquidity measure, government is RBI is very concerned about the liquidity, and he has also mentioned in the MPC about the liquidity, which is a good thing and a heartening thing. Coming on the inflation number for the next year, it is 4.20%, which is in line with our expectation also. And GDP number also we expect with the things, the way government has taken in various initiatives during the budget also, household expenditure is expected to increase. So that may be the reason for forecasting little optimistic GDP growth.
Well, always a pleasure to welcome Dr. Ashima Goel to take her inputs on the credit policy. Ms. Goel, good morning. Thank you for joining us. What is good about the credit policy? What is bad about the credit policy? What is missing in the credit policy? And your smile tells me that you're happy with the credit policy.
Yes, I think it's really time that we started on the rate cuts. They're already delayed. So there's scope for more, but given the global volatility, it is good to start in small, steady steps. And this gives the guidance to the market that they can expect further easing. Data-based, the MPC should always be and has been data-based in the past. And the talk about easing liquidity is very important also, that the exchange rate is market determined, but the RBI will prevent excess volatility. So there need not be fears of sudden very large depreciations, or if there is such a depreciation, it would be reversed, because that would mean an overshooting of the exchange rate. Already the real exchange rate is at 104, so it's marginally appreciated. There's still room for some more depreciation. In general, for the economy, it is good to keep real interest rate, real repo rate, and real effective exchange rate near equilibrium levels. For me, that real interest rate is around 1%. The economy does best if it is at that level. And since we want growth to recover, real repo rates should come down towards that. And we have enough buffers to ensure that we don't have to respond to the exchange rate. The interest rate, the MOU of the MPC is for inflation and growth, domestic parameters. So the interest rate is not tied to the exchange rate. The RBI has multiple instruments to moderate excess volatility there.
Ms. Goel, now the governor also spoke about the real GDP growth, and that is between the bracket of 6.3% to 6.7%. My question to you is, do you think that growth can be maintained given the kind of macro headwinds that we're seeing in the global economy? I mean, you can't really be sure about what Trump does next.
I think we should not be so focused on Trump, because our own economy is highly diverse and has the ability to absorb foreign shocks. We are not a small open economy that is entirely, everything is determined by what happens outside. And we saw in the post-pandemic period that we grew at very high rates, even though the rest of the world was not growing at such rates. So over the last year, the slowdown, the origin is largely domestic. There was fiscal, monetary, as well as prudential tightening altogether. So we are seeing that the government is now spending. The budget has been announced. They're catching up on the lag in capital expenditure. So the fiscal contraction is reversing. Now monetary contraction has also been reversed, and liquidity is plentiful. So we should find monetary financial conditions are also relaxing. So we should see recovery. This slowdown is cyclical and it should turn around. So I do not think 6.7 is an ambitious forecast. We could see growth coming up even higher than that. Our potential growth is higher than that as conditions improve in the domestic markets.
Right, Dr. Goel, good morning. Cheryl also joining in the conversation. I wanted to talk about liquidity, given the fact that you had the governor speak about the liquidity, saying that they are committed to providing sufficient liquidity, proactively take appropriate measures on that particular front. But the street is not too enthused about it, given the fact that they did not see any concrete sort of an action on that particular front. What's your take?
I think that earlier RBI was in the withdrawal stance for a long time, and therefore they were keeping liquidity tighter. But they have the tools, even though the market is worried that there are large outflows, and this tends to tighten liquidity. But if the RBI wants to, they can neutralize, they can sterilize the impact on liquidity of those outflows. They have the tools to do that. So the commitment that they are going to do that means that liquidity will not tighten, it will stay adequate in the future.
So, Ms. Goyal, as an MPC member, if you were part of MPC, would you have voted for the obvious things which the current MPC team has done?
Yes, since June, I've been voting for a cut. In fact, I wrote an op-ed recently saying to cut or not to cut Hamlet's question and argued for a cut. Because, although the dominant market view was that there should be a cut given the slowdown and that inflation is coming to it, absolutely reaching the target almost. But there was a worry about external factors, the Trump factor. So I'd argued that we don't need to anchor our policy on external developments. We have sufficient tools and we should go ahead with the cut, because why we did well after the pandemic was that we had counter-cyclical policy. We smoothed the impact of external shocks. Now, if we sit and do nothing and say, okay, Trump, volatility, global demand is falling and our own demand is falling and we are not countering it, that would make things much worse. That would aggravate the global shocks. So the steps taken today are part of smoothing external shocks and keeping our growth going. We see very positive things. Over the last 3 years, we've had high growth. And the latest data on employment is showing a rise in firms' employment. Yeah. So that will also create demand and generate a virtuous cycle in the economy. So it's very important to smooth growth, keep it high, and let our own domestic demand drivers fire and growth drivers fire.
Leave it there. Thank you, Dr. Goyal, for joining us today to give us your view, especially sitting on the other side this time around. So thank you so much for being part of the show. But let's bring on board Indraneel Pan of Yes Bank, as well as we have Tribhuvan Adhikari, who's the MD and CEO at LIC Housing Finance, joining us now. Mr. Adhikari, let me come first to you, given the fact that, yes, you have that first rate cut come in about 5 years or so. What's your view about that, and how do you think that this will help the demand going ahead?
Yeah, I welcome it. I welcome it. Definitely after 5 years, the first rate cut, well, the first initial reaction would be for lenders would be that, okay, it will put some pressure on the NIMs, etc. But on the other side, I think the borrowing costs also should come down. I think the policy has just been announced, need to get into it further to really make sense of what all has been happening. Just a quick look at the TV screen, I saw the bond yield go up by 3 basis points, slightly counter cyclical to what should have happened. But again, I believe they've lowered the growth forecast also to 6.4. And maybe that's what's playing in the minds of people. But I think this rate cut coupled with the income tax relief given in the budget, I think it should be a growth driver for housing finance companies like us.
All right, let me come to you, Mr. Indraneel Pan. Indraneel Pan, ladies and gentlemen, is the Chief Economist at Yes Bank. Thank you very much, Mr. Pan, for joining us on our special monetary policy coverage. Your first thoughts on the governor's address and, of course, that rate cut that has come in. How are you looking at this, and what are the big challenges now that you're seeing with respect to the Indian economy?
Well, our sort of core view was that there should not be a rate cut. However, the whole of the market more or less was inclined towards a rate cut. And if you really look at the commentary from the Reserve Bank governor, I think this is more like a cautious rate cut that has been provided probably to complement the push that has happened to the economic growth through the fiscal. That's one of the major reasons, in my opinion, why the RBI governor has proposed a rate cut, or the MPC committee has voted for a rate cut. Now, the second is obviously the monetary policy needs to be forward-looking, and the projections of the RBI in terms of inflation for the next year goes down to sub 4% level in the third quarter, which also possibly has been a reason why rate cut has been announced. The liquidity stance, however, and the overall stance of the monetary policy remains neutral, which also tends to very critically indicate that there is still some amount of sort of hesitancy in terms of calling outright victory on inflation and the RBI could actually be factoring in some tail risks on inflation coming out of global tariff policies, commodity prices remaining firm, some amount of depreciation pressure that we are basically seeing at this point in time. The RBI did not really sound a significant worry on the growth. 6.4 is what they have accepted to, which has also been the projection of the government. For the next year, the economic survey projected a 6.3 to 6.8. The budget has looked at a nominal rate of 10.1%, and the RBI's projection broadly falls in line at about a 6.7%. So there is no critical worry on the growth that has been sounded out in this policy.
All right. Let me come to you, Mr. Binod Kumar. Ladies and gentlemen, Mr. Binod Kumar is the MD and CEO of Indian Bank. Mr. Kumar, Mr. Indraneel Pan is of the view that this should not have been a rate cut. What is your overall view? And secondly, I want to also ask you on the consumption and demand boost. With the kind of statements that have been made by the governor today, what is your overall expectation and anticipation?
My expectation, market was expecting rate cut of 25 basis point, and which governor had delivered. Because if you see the sequentially, inflation rate has gone down in December and January also, and Rabi crop is also good. So it was expected there was rate cut expected of 25 basis points. So it is in line, and it will definitely as per demand for the MSME and retail sector, because coupled with the measure taken by the central government during the budget. Coming to the, I missed your next point actually.
Yes, sir. I was asking you about a demand. All right.
So demand, yes. This rate cut will spur demand for both MSME and retail sector overall. Because if you see MSME and retail sector, which are the backbone of the economy and driver of the economy, they are directly linked to the external benchmark. So once this rate cut, it will be passed on to the customer. We expect people may go for the expansion, and it will also spur demand. Thank you.
Right, Mr. Adhikari, let me come back to you because, as a consumer, I would want to ask you this question. We've been all waiting for the rate cut. The rate cut has actually happened. By when will consumers actually see that transmit to the home loan rate cuts and your auto loan rate cuts then? Maybe you can speak about home loan only.
We are into the home loan segment only, so I can talk of home loans only. Very early, I think that our policy announcements have just been made. We need to sit back, analyze, have a look at it. Liquidity is still tight in the system. Borrowing costs are not coming down at all. As I alluded, bond yields have gone up by 3% despite the rate cut. So we really have a look at the entire way the thing pans out, because it's not simply a question of repo rates coming down. We also need to look at borrowing costs, what happens on the borrowing cost front. But definitely, as far as possible, we will try to pass on this rate cut to our consumers.
Okay, now let's start breaking it down. Why should markets get excited about a rate cut? Well, rates go down, demand goes up. Liquidity comes back, lending starts increasing. The assumptions of a GDP growth are based on the wheel of the economy moving, and liquidity coming back means the lending activity will start. But transmission kitna hoga? Simple. It is very, very simple. The transmission kitna hoga. And Mr. Kumar, when RBI has increased rates, my home EMI goes up in 15 days. 15 days I get a letter from the bank, EMI has gone up, or you adjust the loan period. This time, in how many days should I expect a letter now the Reserve Bank of India has cut rates?
See, there are
everybody wants to know on this panel. Banks बढ़ाते जलती हैं, गिराते कम है.
So see, there are two components. Normally now loans are linked to the two components. One is the MCLR, one is the external benchmark. So loan which are linked to the external benchmark, rate will be passed on immediately. Once banks will have to convene their ALCO, and once it is approved in the committee, it will be passed on to the consumers. Next, which are linked to the MCLR, so that will depend on the marginal cost of funding. If you see overall, there is pricing pressure on deposit side. So marginal cost of funding may be, it may not go down. So in that case, MCLR may remain at the level it is now. So loans linked to MCLR may take some time in passing on to the customer, but the loan which are linked to the external benchmark, passing out on it on will be immediately once ALCO is convened by the different banks.
Let me come to you actually and ask you this question. Given the fact that yes, you have 25 basis rate cut, but given the fact that that tends to trickle down very slowly when you talk about transmission, what's your view on that? By when can we expect that to happen? Tanvi?
So on the transmission, I think if you look at the rate cut scenario, I think the transmission is going to be asymmetric. As a lot of experts in this call mentioned, we need to see how much flexibility we are going to see in terms of actual transmission, in terms of lower lending and the borrowing cost. But if I look at what we are estimating in our base case, a 75 basis point rate cut over the course of 1 year, I would say the transmission could at least be 40 basis points. So clearly, if you look at the macroeconomic environment, India needed policy stimulus, both monetary easing as well as a fiscal stimulus. I mean, fiscal stimulus, we understand the government hands are tied. They did try to give some kind of consumption boost. But what is needed more from a monetary is that liquidity conditions remain lower for longer. And I know it's a very hard step, especially at a time when global volatility is very high. Global financial markets are tightening. And on that, I think India will get affected. We have seen a lot of measures by the RBI, OMO purchases, FX swap, variable reverse repo rate options. But what we need is a very consistent framework by the RBI to boost interbank liquidity. So more than rate cut, I think it's the interbank liquidity, which is a bigger concern for market participants in terms of consistently reducing the monetary or consistently helping with the monetary transmission. So I think the first step is liquidity conditions remain neutral. We have seen a significant improvement over the last 10 days, but we did see in mid of Jan, the liquidity was at a 15-year high deficit. And the second is, then we talk about transmission, where I think we need a lot more monetary easing, at least 75 basis point to actually have any real impact on the economy.
Appreciate your time. Thank you for joining us. I'm just going to turn to my right. Kunal is always on my right side. But markets are not on the right side after the monetary policy.
But that's okay. I don't see this as a major negative reaction, Nikunj. It's just 200 points. At least the volatility is a lot more contained for the index than what was on the budget day. On the budget day, we saw a 1200 point swing for the Bank Nifty, almost a 350 point swing for the Nifty. This time it's exactly half of that. So it's just 170 point swing for the index and 600 odd points for the Bank Nifty.
I could look at the Nifty and say, okay, all the event risk over.
Exactly.
And I should say that, okay,
yes,
good, bad, all the event risk over, markets have adjusted.
yes.
Or another way of looking at it is that what will generate short covering? If there is no event, there are no triggers which will scare the bears. What is the right way of looking at the market?
So now the markets would come back into that traditional plate. We look at the global cues, we look at the arena where the markets have been trading, whether, for example, the US bond yields, dollar index, etc. So we'll come back into that traditional setup for the indices. And that, I believe, is the bigger victory for the indices, because there could be multiple things which could happen all together this time around. You can see a drop in India VIX, you can see a reduction of short positions, you can see the index coming back into a groove of large cap names, then you can see eventually the financial tilt and the banking tilt, which did pretty well for the indices over the last 2 weeks. That could strengthen more. You could see a short covering spree across underperforming sectors, autos, FMCG. So I think now we come back into that traditional play. That, I believe, could be a lot more positive in terms of the trend for the indices.